Most traders think their biggest problem is losing trades. It's not. Their biggest problem is not knowing when to stop. One trade turns into three. Three turns into seven. And suddenly you've taken more trades in one day than your strategy was ever designed for. Not because the opportunities were there, but because the urge to trade was. This is the trap of overtrading. And the dangerous part is, most traders don't even realize they're doing it. They think they're being active. They think they're working harder. They think more screen time means more opportunity. But in reality, they're slowly draining their account, one impulsive click at a time. Let's be honest for a moment. How many times have you said this to yourself? Just one more trade. Not because the setup was perfect, but because you wanted another chance to recover a loss, another chance to catch a move, another chance to feel like you're back in control. That's not trading. That's emotion negotiating with discipline. The market is a place where patience gets paid, but the human brain hates patience. Your brain wants stimulation, it wants action, it wants movement, and the market gives you infinite opportunities to click. But opportunity is not the same as edge, and most traders confuse the two. Here's the uncomfortable truth. Overtrading is not a strategy problem, it's a dopamine problem. Every time you open a trade, your brain releases a small hit of excitement. Win or lose, it doesn't matter. Your brain still gets stimulation. And over time, you start chasing that stimulation, not profits. You begin checking charts constantly. You start scanning pairs that aren't even part of your plan. You zoom into lower time frames hoping to find something. You convince yourself a setup is there even when it isn't, because the urge to trade becomes stronger than the discipline to wait. This is where accounts slowly bleed out, not from one huge loss, but from many small, unnecessary ones. Trades that were never part of the plan. Trades taken out of boredom. Trades taken out of frustration. Trades taken because the market was moving and you felt left behind. And by the end of the day, you're not even sure why you entered half of them. Professional traders understand something retail traders struggle with. Sometimes the best trade is no trade. But that idea feels wrong when you're starting out. Doing nothing feels like missing out. Waiting feels like weakness. But waiting is actually one of the most powerful skills in trading, because the market rewards precision, not activity. The amateur trader wants to feel busy. The professional trader wants to feel selective. Big difference. One chases movement, the other waits for high probability moments. Think about a sniper. A sniper doesn't fire hundreds of bullets hoping something lands. He waits, sometimes for hours, sometimes for days, for one clear shot. Trading works the same way, but most traders behave like machine guns, clicking over and over, hoping something finally works. And when it doesn't, the cycle continues. Loss, frustration, more trades, bigger mistakes, until the account slowly disappears. Not because the trader lacked intelligence, but because they lacked restraint. Overtrading is rarely about the market. It's about what's happening inside you. Boredom, fear of missing out, the need to recover losses, the excitement of being in the game. All of these emotions push traders to break their own rules, and every time that happens, discipline weakens. The dangerous part? It often starts small. You take one extra trade, then another. Then you tell yourself, it's still within reason. But the line keeps moving, and before you realize it, your trading day has turned into emotional gambling. Here's something most traders never consider. Your strategy was designed for specific conditions, specific setups, specific probabilities. When you start taking random trades outside that system, you're no longer trading your strategy. You're trading impulse, and impulse has no statistical edge. That's why overtrading is one of the fastest ways to destroy consistency, because it mixes good trades with bad ones. And once that happens, your results become confusing. You can't tell if the strategy is failing or if your behavior is. And that uncertainty leads to an even bigger mistake. You start changing the strategy instead of fixing the discipline. So the real question is not,
Why am I losing? The real question is, why do I feel the need to trade when nothing is there? Because the moment you answer that honestly, you begin to understand the real battle. And the real battle in trading is never just the market. It's yourself.
Because overtrading rarely starts with greed. It usually starts with fear. Fear of missing out. You see the market move without you. A big breakout, a strong trend, a candle that runs exactly the way you predicted earlier. And suddenly, your mind starts racing. I knew it. I should have taken that. I missed the move. And in that moment, you feel left behind. This is where many traders make their worst decision. Instead of accepting the missed opportunity, they chase the next one. They enter late, they force a setup, they convince themselves the move will continue. But markets don't reward emotional chasing. They punish it. The trade reverses. Now you're down, and the mind immediately searches for a solution. Okay, I just need one good trade to recover this. This is where overtrading evolves into something even more dangerous: revenge trading. Revenge trading is emotional momentum. One loss fuels the next decision, and every decision becomes less rational. Your analysis disappears, your plan fades, your risk rules start bending, and the only thing left driving your actions is the desire to get back what you lost. But the market doesn't care about your last trade. It doesn't care about your account balance. It doesn't care about your frustration. The market only rewards discipline and probability, and emotional trading destroys both. Here's something most traders never notice. The moment you start overtrading, your focus shifts. You stop looking for good setups. You start looking for any setup. Your brain lowers its standards. It starts saying things like, "This one looks close enough. It might work. I'll just try it." And that tiny shift in thinking is where consistency dies. The professional trader protects one thing above all else: selectivity. Because selectivity protects your edge. Your strategy might only produce 2 or 3 high-quality setups a day, maybe even fewer. But those few trades are where the real probability exists. When you start forcing extra trades, you dilute that edge. And diluted edge equals inconsistent results. Imagine a casino. A casino doesn't offer games that guarantee profit every minute. But over thousands of rounds, the math works in their favor. Now imagine if the casino started changing the rules randomly, just because they felt bored, or because a player won a few hands. That would destroy their edge. Yet that's exactly what traders do. They abandon structure the moment emotions rise. The truth is, most traders don't lose because of bad strategies. They lose because they can't sit still. They feel the need to participate constantly. But the market doesn't reward participation. It rewards precision. Let's look at a simple reality. A disciplined trader might take 2 trades today. An emotional trader might take 12 trades. Which one do you think ends the day mentally exhausted? Which one is more likely to break risk rules? Which one is more likely to spiral into mistakes? It's not hard to see the difference. But when you're inside the moment, emotion clouds clarity. Another hidden danger of overtrading is decision fatigue. Every trade requires analysis, entry decisions, stop placement, risk calculation, exit management. The more decisions you make, the more mental energy you burn. And when mental energy drops, your discipline drops with it. That's when careless trades appear. Professional traders understand something powerful. Your mental capital is just as important as your financial capital. If you drain your focus early in the day, the quality of your decisions later will collapse. That's why experienced traders often stop trading after a few trades, not because the market closed, but because their mental edge has limits. This is something beginners rarely respect. They think more trades equals more opportunity, but in reality, more trades often equals more mistakes, because every extra trade increases the chance of emotional interference. And trading is a game where small emotional mistakes compound quickly. Here's a simple exercise.
Look at your last 20 trades. Be brutally honest. How many of them were perfectly aligned with your strategy? And how many were late entries, impulse trades, boredom trades, revenge trades? You might discover something uncomfortable. Many traders realize that half their trades were unnecessary, and unnecessary trades are the silent killers of accounts. But here's the good news. Overtrading is one of the easiest problems to fix, not because it's easy emotionally, but because the solution is simple. Structure, rules, limits, systems that protect you from yourself. And once those systems are in place, your trading suddenly becomes quieter, cleaner, more controlled.
Now let's talk about the solution. Because knowing the problem is not enough. You need systems that stop overtrading before emotion takes control. And the first system is simple: a trade limit. Most traders never set one. They sit down at the charts with unlimited freedom, unlimited clicks, unlimited opportunities to break their discipline. And when there are no limits, emotion eventually takes over. Professional traders often do something very different. They define a maximum number of trades per day. Maybe it's 3, maybe it's 5. But once that limit is reached, trading stops. No negotiations, no just one more, no exceptions. Because the rule exists for a reason. It protects them from themselves. At first, this rule feels restrictive. You might feel like you're missing opportunities. You might feel like the market is moving without you. But that discomfort is actually a good sign. It means discipline is starting to replace impulse. And discipline always feels uncomfortable in the beginning. The second system is even more powerful: a daily loss limit. This rule is brutally simple. Once you lose a certain percentage of your account for the day, you stop trading immediately. No recovery trades, no revenge trades, no trying to fix the day. Because the moment you're emotionally affected by losses, your decision-making becomes unreliable. The professional trader understands something important. A bad trading day is not dangerous, but a bad trading day combined with emotional decisions is extremely dangerous. That's how small losses turn into catastrophic ones. The third system is something almost no beginner wants to do: a pre-trade checklist. Before every trade, you must answer a set of questions. Is the setup part of my strategy? Is the risk within my rules? Is the market condition correct? Is my entry planned? Is my stop loss defined? If any answer is unclear, the trade doesn't happen. This simple process slows down impulsive decisions, and slowing down emotion is one of the most powerful things you can do in trading. Because overtrading thrives on speed. Impulse loves fast decisions. Emotion wants immediate action, but discipline requires pause, reflection, verification. And that pause is often enough to stop a bad trade. Another powerful habit professional traders develop is accepting missed trades. This sounds simple, but psychologically it's very difficult. Your brain hates missed opportunities. It treats them like losses, but they're not losses. They're simply moments that passed, and the market will create thousands more. Think about this. The market has been moving every single day for decades. There will always be another setup, another trend, another breakout, another opportunity. You don't need every move. You only need the right ones. This is where maturity starts showing in a trader. The beginner wants to catch everything. The experienced trader becomes comfortable letting most things go because they understand something powerful. Opportunity is infinite, but emotional control is limited. So they protect their emotional energy. Here's a mindset shift that changes everything. Instead of asking, "How many trades can I take today?" ask, "How few trades can I take while still executing my edge?" This question forces selectivity, and selectivity protects discipline.
At some point in your trading journey, you'll realize something surprising. The less you trade, the better your results become. Because fewer trades usually means better trades. More patience, more clarity, more alignment with your system. The traders who survive long-term are not the most active. They're the most controlled. They understand when to act and, more importantly, when not to. One day, you'll open your charts, you'll scan the market, and you'll see nothing worth trading. In the past, that moment would have created frustration. You would have forced something. But now, you simply close the platform and go live your life. No stress, no urge to click, no feeling of missing out, just calm acceptance. That moment is powerful because it means you've reached a level many traders never reach. You've learned that discipline is more valuable than activity. And once that lesson truly sinks in, overtrading loses its power over you. Because now you understand something most traders don't. Your edge is not just your strategy. Your edge is your restraint. And the moment restraint becomes part of your identity, consistency finally has room to appear. But there is one final mindset shift that separates average traders from the ones who truly last in this game.
So let's end with the mindset that truly separates professionals from everyone else. Because systems help, rules help, limits help, but none of them matter if your identity as a trader doesn't change. Most struggling traders secretly believe that success comes from finding more trades, more entries, more signals, more chances to win. But professionals think the opposite way. They believe success comes from avoiding bad trades. That's a completely different mindset. One focuses on action, the other focuses on restraint. Think about it this way. Your account doesn't grow because you trade often. It grows because you trade correctly. And correct trading is rare. High probability setups don't appear every hour. Sometimes they don't appear every day, but that's normal. The market is not designed to give you constant opportunity. It's designed to test your patience. The trader who survives long-term learns to become comfortable with quiet days, days where nothing happens, days where you simply observe, days where the best decision is to stay out completely. Because sometimes the most profitable action is patience. The moment you stop forcing trades, something interesting happens. Your chart reading becomes clearer. Your mind becomes calmer. You stop seeing fake setups everywhere. You start recognizing the difference between movement and opportunity. And that clarity is powerful because emotional noise disappears. You begin to trust your process. Not because every trade wins, but because every trade follows the rules. Losses become easier to accept. Wins feel less emotional. Everything becomes more neutral. And neutrality is the environment where consistency grows. There's a quiet confidence that comes with disciplined trading. You're no longer chasing the market. You're waiting for it. You're no longer reacting emotionally. You're executing strategically. You're no longer trying to prove something. You're simply following your edge. And eventually, something changes inside you. The urge to click constantly disappears. The excitement of random trades fades. You stop feeling like you need to be in the market all the time. Instead, you begin respecting the moments when not trading is the right decision. That's when you realize something most traders never discover. The goal of trading is not to trade more. The goal is to trade better. Better entries, better discipline, better emotional control, better patience. Overtrading is not a technical problem, it's a psychological one. It happens when emotions take control of decisions. But once discipline becomes stronger than emotion, the cycle breaks. You stop chasing losses, you stop chasing moves, you stop chasing excitement. And when that happens, your trading becomes quieter, more focused, more controlled. And that's the real secret most traders overlook. Consistency is not built through activity. It's built through restraint, through patience, through discipline, through the ability to sit still while others panic and chase. Because in the end, the market does not reward the most active trader. It rewards the most controlled one.
And the moment you truly understand that, overtrading stops being a temptation. It becomes something you simply no longer need. That's when the shift happens, from emotional trader to disciplined operator. And once that shift happens, everything in your trading begins to change.